Chapter number 6, Financial Statement Analysis. Financial analysis. Financial analysis is a process of analyzing and interpreting financial statements. Analyzing means simplifying the data, and interpreting means explaining the meanings and significance of data so simplified. Critically examining the accounting information given in the financial statements. Evaluating the relationship between the component parts of financial statements to obtain a better understanding of firm's position and performance. Financial statements. Financial statements, it is the outcome of summarizing process of accounting. It includes profit and loss account, balance sheet, cash flow statement, and statement of shareholders' equity. Means of conveying to management, owners, and interested outsiders a concise picture of profitability, financial position, and cash position of the business. Its purpose is to convey an understanding of financial aspect of business firm. Steps of financial analysis. Establish objectives of the analysis. Define extent of analysis, organization and rearrangement of financial data, relationship among financial statements with the help of tools and techniques, interpretation of information, drawing a conclusion. Tools and techniques. Comparative statements, horizontal analysis, trend analysis, fund flow analysis, cash flow analysis, ratio analysis, common size statements, vertical analysis. Uses and limitations. Uses of ratio analysis helps in decision making, helps in financial forecasting and planning, helps in communicating strength and weakness of a firm, helps in coordinating various business activities to achieve goals, helps in making effective control of the business. Limitations. A single ratio can't convey much of sense. Lack of adequate standards. Industries differ in nature and hence their ratios can't be compared. No consideration is made to the changes in place in price level. Ratio analysis. Liquidity ratios, leverage ratio, activity profitability ratios, and other ratios. Liquidity ratio. Current ratio CR is equal to current asset divided by current liabilities. Measures ability to meet short-term cash needs. Quick or asset test ratio QR is equal to quick assets divided by current liabilities. Quick assets is equal to current assets minus inventories minus prepaid expenses. Measures ability to meet short-term cash needs more rigorously. Leverage ratio debt to equity. Debt divided by equity is equal to long term debt divided by shareholders equity. The debt divided by equity ratio, the ratio indicates what proportion of equity and debt a company uses to finance its assets. Debt to capital, long term debt divided by total capitalization. The ratio is used to evaluate firm's financial structure and how its financing operation. Debt ratio, total liabilities divided by total assets. All these measures extent of firm's financing with debt. Turnover ratio, inventory turnover ratio, cost of goods sold divided by average inventory, sales divided by closing inventory. Every firm has to maintain a minimum level of inventory of finished goods to meet business requirements. Inventory turnover ratio indicates whether inventory has been efficiently used or not. Debtors turnover ratio is equal to net credit sales divided by average trade debtors. Indicate numbers of time average debtors are turned over a given year. Average collection period is equal to number of days or months in a year divided by debtor. Turnover ratio represents average number of days for which a firm has to wait before its receivable are converted into cash. It is also called days sales outstanding. Creditor turnover ratio is equal to credit purchases divided by average trade creditors. Total assets turnover ratio is equal to net sales divided by total assets. Fixed assets turnover ratio is equal to net sale divided by fixed assets. Working capital turnover ratio is equal to net sale divided by working capital. Measures efficiency with which working capital is being used by the firm. Profitability ratio. Gross profit ratio is equal to gross profit divided by net sales. Operating profit ratio is equal to operating profit divided by net sales. Operation profit is equal to EBIT is equal to sales minus VC is equal to CM minus FC. Net profit ratio is equal to net profit divided by net sales. Return on equity is equal to net profit divided by total shareholders' equity. Return on assets is equal to net profit divided by total assets. All measures firm's ability to translate sales into profits. Other ratios. Measures of dividend payment. Dividends paid to shareholders. Dividends per share. Weighted average numbers of ordinary shares outstanding. Dividends paid to common shareholders. Dividend payout is ratio is equal to net income attributable to common shares. Plowback ratio is equal to 1 minus dividend pay minus out ratio, the proportion of earnings retained by the company.